Is long strangle right for you? Are you curious about whether the long strangle strategy in options trading is the right fit for your investment approach? Let's break it down together. A long strangle involves buying both an out-of-the-money call option and an out-of-the-money put option on the same stock, with the same expiration date. This strategy is designed to profit from significant price movements, whether up or down, or from a rise in implied volatility. First, let's talk about risk and cost. Your maximum loss is limited to the total premium paid for both options. This can be a considerable amount since you are purchasing two options. If the stock price stays between the two strike prices at expiration, both options will expire worthless. This means you could lose the entire premium you paid. Now, what about profit potential? The upside profit is unlimited from the call option, while the downside profit from the put option can also be substantial. To break even at expiration, the stock price must move beyond the strike price of the call plus the total premium paid, or below the strike price of the put minus the total premium paid. Timing and volatility are key factors in this strategy. A long strangle benefits from an increase in implied volatility or a large directional move. It works best when volatility is low at the time of entry and is expected to rise. However, keep in mind that time decay works against you. As expiration approaches, the value of both options decreases if the stock price remains stable. So, when is a long strangle suitable? This strategy is ideal if you anticipate significant price movement but are unsure of the direction. It is a long volatility strategy, meaning you profit from volatility rather than a specific price direction. However, there are practical considerations. Since the stock must move substantially to be profitable, this strategy carries higher risk and lower probability of success. Traders often use it as a hedging strategy or for speculative plays when expecting events like earnings announcements or major news that could lead to big price swings. Compared to a long straddle, which involves buying at-the-money call and put options, a long strangle is generally cheaper to enter. However, it requires a larger price move to become profitable. In summary, a long strangle might be right for you if you want to take advantage of expected large price movements or volatility increases, can afford to risk the full premium paid, and understand that the stock must move significantly beyond the strike prices to make a profit. If you expect the stock to remain just stable or prefer a higher probability of smaller gains, this strategy may not be the best choice.